Hi, this is Jackie Ann Patterson, and I am recording a short video to get you up to date on my latest research in ETF rotation. Specifically, I've been looking at hierarchical and leveraged ETF rotation. Before I get too far into that, please take a look at the legal disclaimers. Feel free to pause the video if you'd like to read it more closely. I'm definitely talking about trading style that I actually do, and I've got a mixture of live results and simulated. Of course, simulation is not reality, but it gives us a chance to find out what's going on before we risk real money. Okay, so what I'd like to talk about is just a very brief review of the regular ETF rotation, then go into some results for hierarchical rotation and explain what the heck that is, and then look at rotation using the leverage funds, the direction 3x funds and stuff like that, and see how that improves performance, actually quite a bit. Okay, so as part of the review, my favorite ETFs are listed here. And this should also show you my favorite asset classes, because that's what I'm using the ETFs for, is to pick out whether large caps doing better than small caps, doing better than international funds, or doing better than bonds, and looking for which are the top funds. Now you'll see I've got the SH crossed out at the bottom. I used to include that in the rotation, and it really wasn't adding value, so I took it out and put in the mid-cap stocks instead. And you'll also note that there's two tickers listed for some of these, and that's because there's quite a commission break and a fee break for using the iShares ETFs instead of some of the more popular ones. So using IVV instead of SPY, using IJR instead of IWM. And so what I'm doing is I'm looking at the ranking using the more popular liquid actively traded ETFs, and then for my own positions I'm using the lower cost ETFs, which I believe still have enough volume to get us by. And as I look at this now, I realize, I should list out the international funds, the secondary funds there, because once those do come back, right now international is at the bottom of the heap. And so it's not really imperative to understand the secondary fund that we might rotate into. But sooner or later, they'll probably come back. And at that time, we'll want to know what the funds are that we would prefer to buy into. Okay, so on to the next slide. So using that set of ETFs, what I want to do is go through the rotation rules. And these have been updated with the look back period as of the third edition of the book. So every week I'm assessing the portfolio, not necessarily doing something every week, but always looking at it. And because the market can get away. If you wait till the end of the month, something important might have happened, and definitely waiting till the end of the year, the whole thing could have changed. So looking every week, but only acting when there's a signal. And what I want to be doing is holding the top two of those 7 ETFs, as long as they've got a positive gain over the past 114 trading days. And so I can calculate that percentage gain using the difference in the price plus adding in any dividends that occurred. And it's very important to add in the dividends, because that's about a 3% difference I've noted in the simulation and in real life between calculating the percentage gain using dividends or not, and having dividends actually reinvested in the account or not. So the appropriate thing to do is to consider dividends in the calculation, and in the account have the broker automatically reinvest dividends so that they come into play right away when they happen. Okay, so what we are doing is looking at the ranking of the 114-day look-back period, checking out which of these 7 ETFs are on top. And I'd like to be in the top 2 as long as they've got a positive gain. And if nobody has a positive gain, or if only one does, it'll go to cash for that missing position. So this has a way to get defensive and protect us from downturns in the market. And in order to not have quite so many whipsaws, this will keep an ETF while that ETF still stays in the top half of the ranking. So we'd like to buy 1 and 2. If 2 drops to 3, that's okay. But once it drops down to number 4, then that's in the bottom of the ranking and it'll get sold, and then we'll pick something from the top 2, whichever one we don't hold. We'll buy that top ranked ETF as long as it's got positive gains. And then at the end of each year, I want to rebalance these 2 halves of the portfolio. This is typically challenged because I'm typically on a ski trip, but the idea is to have 2 equal halves with the 2 different positions and use that going forward. So that's a summary of what the current rotation rules are. Adding to that hierarchical rotation, what that means is picking the first asset classes, pick out the top 2 just as before, but instead of investing directly in those, look at a subset of ETF that's in those classes. So for example, if large cap, like SPY is the top asset class, well then look at underlying, whether you could either look at the industry groups, or I prefer to look at value versus growth, and see what's on top and buy that. And by that way, try and get into a more focused ETF that's moving even faster than the main index. So let me show you on the next slide, kind of illustrates the pool of ETFs. So in the center around the core is the main asset class ETF, with AGG for bonds and SPY for large caps and IWM for small caps, and well, there's cash. So say for example, back on our example where SPY was chosen as one of the top ones, well then we could have a comparison between IVE, the value, and the growth. And so this is what this circle is illustrating for MDY. Likewise, and you can see the hats. So we got the large cap is a big crown, small cap is a tiny ski cap. Here we have in between the MDY, and then the 2 funds that would be more focused to trade into. And for the country funds, we've got quite a few for the developed markets, and even more for the emerging markets. So this gives quite a selection and a good chance to drill down into a faster moving ETF. So looking at the performance here, you're looking at 2 curves. So at the top in blue is the compound annual growth rate, and the axis is the look back period, is what each step, each point along this line is, and then it's showing in blue how much compound annual growth rate came out for each setting, and then down in the bottom yellow line, what was the maximum drawdown. And the drawdown is how much money the account lost, an open loss, in between its highest point and its lowest point. So this is a measure of how volatile the strategy is, and also how bad our stomachs feel as we look at our account balance. And for reference, you know, the S&P 500 can easily lose half of its value in the big crises we have. It just drops down by 50%. So having a rotation strategy that's got a max drawdown less than 20%, and in fact in the kind of sweet spot is there in between 111 and 121, where there's a high compound annual growth rate and there's a low drawdown. So that's a good setting to use, and that's why I'm focused in on the 114-day look back. Okay, so looking at the sectors, so previously, this is going to jump between some very similar charts. So this first chart was the basic rotation, which is doing, what we're doing each week in the model portfolio. On this next chart that I flipped to, this shows the results of doing the sector rotation. And you can see that point in between 111 and 121 with the compound annual growth rate is not quite as good, and the drawdown is worse. So, and that's almost throughout. the situation that doing this hierarchical rotation didn't help very much. Well, we see it also here with the styles. So this one is rotating in between the different value and growth for the different stock funds, whereas previously, flipping back again, this is rotating between the sectors like healthcare, technology, and whatnot. And there's the handful of sectors for both large caps and small caps. So we're having a chance to try out several different ways here and compare. So sectors, not as good as the basic. Styles, also not as good as the basic. Maybe a little bit better with the styles, and the drawdowns not quite so extreme. Okay, so to kind of summarize this for one, looking at one look back period, the 114 trading days, and this is also kind of useful if you like to look at a table of results instead of trying to compare those dense graphs. So the basic rotation did come out better, and we can see that for the time period, and this is very time period dependent, and I'll show you some different results for different time periods so you can get a feel for that. But the 2012 to 2017, which was a pretty strong time in the stock market, the rotation had a compound annual growth rate of 12%. Theoretically, this is all theoretical. I'll show you some live results later, and a max drawdown minus 14%. So the next box, VTI, this is a Vanguard fund, which just buying and holding that would return 15% with a 15% drawdown. So that's pretty good. And just a commentary on that, you know, there are stretches, and particularly stretches like this one, 2012 to 2017, where the market doesn't go down, and it looks pretty darn good to be in buy and hold. And, you know, going back as far back as we go, even considering those big, deep crises in the market where it lost half of its value or more, it has come back so far. So for people who have the temperament to do a buy and hold, I can certainly see where they're looking at some numbers and gaining confidence for that. I personally don't have that kind of confidence that the market will always come back in my favor at the time I need it. And as a consequence, I don't do well as a buy and hold investor. I may start out to do that and sell at the wrong time, or I just don't put the money in. So the value of the ETF rotation, to me, even though I look at this number for this 5-year time period and say, yeah, it produced less money in income, but it allowed me to get in. It gave me the feeling of safety that I'll be able to get defensive and get out, and that is what allows me to make the investment in the first place. Okay, so back to looking at the results here, and the third set of results is SSO. That is a Pro Shares 2 times the S&P 500 ETF, and you can see it did almost 2 times the VTI, produced a better performance with a greater drawdown. And I guess the next one is where you could compare it exactly to S&P 500 with the SPY and see that, yeah, you know, the SSO in this case did pretty much what its charter is of 2 times. It won't always be that good, but in this case it was. Then I also looked at the original baseline that I had set out in the book of holding 12.5% of large caps, small caps, international stocks, being developed markets and emerging markets, and then the other 50% in bonds. So how that performed over the time period gave about the least results overall, and it had a pretty healthy drawdown. So just holding on to those funds is definitely not ideal, and especially if we see a big raise in interest rates, the bond funds will get slaughtered. So that's why we're looking at rotation. And the next 2 boxes have the subject of this video, which is the hierarchical rotation, going through the sectors and through the styles. So as noted, it did not perform as well as just doing the basic rotation, either one of them. So there's not much motivation to drill down and do that style of rotation with all the extra work that that entails. Okay, so on the next foray into research, I looked at what would happen if leverage funds were used instead of the basic ETF. So that by leveraged, I mean the ones that are set up to track on a daily basis, they're careful to say, 3 times the movement of the underlying index. So for example, IWM moves at its own pace, and TNA will attempt to return 3%, TNA will attempt to return 3 times the amount of the IWM gains. Now, for most of them, it's just a 1-to-1. There's not that many country funds. I did do an experiment with the large cap. There was enough history with the sector funds for large caps to do a rotation with that. And then you also see SPXL sitting out there. So I did a rotation just using that as well for comparison purposes, especially seeing how the sectors didn't help that much in the other rotation. All right, so here we're looking at the theoretical results for doing the hierarchical rotation and using the large cap sectors. And a similar looking graph to the others, but note that the scale is much different. So that that nice plateau surrounding 114 trading days is now up at 30% for the sector rotation. The drawdown, however, is also at minus 30%. So on the one hand, that seems pretty big, and I've actively looking to reduce that. On the other hand, it's about 1 year's earnings. So carrying on with this strategy for many years probably would be okay. So let's look at the next graph. So I also took a look at what happened if I just used the leveraged funds and didn't have any hierarchy, just went straight to SPXL and TNA and DZK and EDC and all the others that were on that circle, and just throw them into the hopper and do a rotation in a similar way with those funds. And it came out pretty good. It's not as clearly coming up over 30%, partly because I didn't put the line on this graph. That's too bad. There is one point that comes up over 30% for this. The drawdown is more at max drawdown at minus 40% is about as good as it gets. One of the things that makes this much more realistic is that there is not much volume in trading volume for those leveraged sector funds. So some of them are trading like on average 6,000 shares a day. So if just with our small tribe of ETF rotation people here, if we all trade on the same day, we could easily overwhelm that volume. So I think that's probably not going to be a good thing to do, and it's probably worth it. There's already risk enough in these leverage funds to just do the basic rotation and not try and go down into the hierarchy. Okay, here out of this big graph, you probably want to pause and look at it. Maybe you want the explanation and then pause and let it sink in. So what I'm trying to do is make a table and compare what happens with buy and hold simulation on each of these different things, with the SPY, with the 2 times the S&P 500, that's SSO, 3 times with SPXL, and compare that to the baseline and also to the leveraged fund rotation. And then on the different columns are different starting years. They all run to 2017. But by starting at different times, you get very dramatically different results. And especially including 2007, then you get the benefit of seeing this debacle of the credit crisis and the impact that that has. And it's interesting to note that during that time, having that time frame in there, well, first of all, some of the leverage funds weren't available at all. If they had been available, they probably would have blown up. So we would have had a complete loss had we stuck to them. So it definitely says that we can't just sit and hold these leverage funds without a plan to get out. And also looking at the comparison between SPY and SSO for 2007, that's not 2x the results. These funds are doing various things for leverage that may not have a linear performance, and so they don't return. And in particular, they seem to fall faster when the underlying index is going down. A 2x or a 3x bullish fund will fall faster than the 2x or 3x specified. When it's rising, it may not rise as fast due to the drag on it, due to the leverage. And so you can pick some out, like looking at 2012 to 2017. So, there you're seeing where SPY comes in at 15%, double that would be 30%. Well, it's not quite there. And 3 times that would be 45%. And so you see a little bit of the loss due to friction, you might say, due to the cost of leverage creeping in. Okay, so I showed you this whole chart just because I'm going to plug in numbers and use different time frames, and I don't want it to seem like a shell game here, and I want to have this reference table to go back to. So, okay, on to some more interesting results, because we're never going to buy and hold any of these things. Okay, so looking at the leveraged performance and comparison, 2012 to 2017, and again, need to only go back to 2012 because the hierarchical funds, or the funds used for the hierarchy, those sector funds, were not available any earlier. So we can see that just holding, if you were theoretically going to do this, SPXL would have produced a 43% gain. But, even the maker of the product says, don't just plan on buy and hold this. You've got to have an active strategy. So that's just there for comparison, and comparing to the hierarchical, the sector rotation, that lost a fair amount of performance, coming in at 28%. And taking all of those funds, the sector funds in the hierarchy, and not trying to be so smart with it, just throw them all in the hopper and buy actually the top 3 because there's so many of them, that returned 29% in the theoretical simulation. And then taking just the heads, I call it the flat heads because there's no hierarchy, but just take the 3x asset class, so the SPXL and the TNA, and that returned 33% with a 35% drawdown. So that's the one that looks pretty good and that I'm going to be focusing my efforts on. In some ways, it would be easier if it were a hierarchical, because then I'd only have to run one ranking. But it turns out that the results came out better to just rank directly the 3x funds. And so that's, going to be the procedure going forward. And kind of an interesting note, and part of why it took so long to get these results together, is that I was doing the hierarchical simulation at first, because I had previously, very early on, like around 2013, done some work trying to simulate the performance of the leveraged funds and see if I could use them. And the results came out pretty poor. So there's a sample set where, and I use it as a warning, that there's going to be times where the leverage funds do not perform nearly as well as the unleveraged. And so what we're looking at here is being able to, over time, make bigger gains and at the same time stay agile so that we're able to get out of these funds before any crisis hits. Okay. On to the next thing. So in an attempt to try and reduce the maximum drawdown, I implemented a simulation with stop losses in the form of what I'll call band stops. So what that was is it corresponds to the number along the x-axis in this graph. If the price took out the low of the most recent 10 days or 20 days or 30 days, 40, 50, you get the idea. If that low was taken out, that was considered a stop loss. And that fund was put on the sidelines and not, could not be held. Money was sold out of it and couldn't be held until the price comes back and takes out the high of the next 10, 20, 30 days. So this gave it a chance to sit on the sidelines and cool off. And as you can see, it hurt the performance. Didn't get nearly as much return, especially with the tight stops. And it actually, in many cases, hurt the max drawdown because it was getting stopped out. And and then changing and getting into something else, which got stopped out again. So that is not too good. And I think back on all of my research to date on stop losses, I regard it as another area where the buy and hold of things that come back anyways. So of the survivor set comes out pretty good without a stop loss. And that when you add in a stop loss, you can generally reduce the performance, but you get some safety. So there's a trade-off there, and I tend not to use the actual stop losses with rotation because we already have the safety valve of rotating out. So I hope that makes some sense. And I do still have some further areas to look at for stop losses. There's a company that has some proprietary algorithms that I'm talking to about their stop loss, because it looks like they have had some reasonably good performance at stopping out and getting the reentry. So the reentry is probably the more difficult thing. We can detect a change in trend and breaking a stop level and get out of there. But the big question is, when do you get back in? If you come in too soon, you get more losses. Come in too late, you miss some of the gains. So that's what's going on currently with stop losses. And then looking at the numbers year by year, so the first 3 columns of this should be quite familiar to subscribers, or if you've looked at the website on the performance data, this gets posted and I report it in the monthly. As the results come out, I report them in the weekly newsletter. And what's added here is a year-by-year hypothetical simulation of doing that flat leveraged rotation. And wow, take a look at 2013. 135%, that's really great. And would really like to have a strategy returning that. At the same time, I look at some of these others, and like for the partial year of April 1st, when I first started doing this rotation, even though it wasn't quite ready, that was actually a loss using the leveraged rotation, even though all the other strategies returned some gains. And then looking at this year to date, that's some pretty lackluster performance also. And then there's 2015, which was kind of the bugaboo year for anybody with an active strategy. Took a hit, and in fact, the flat leverage rotation does make a drawdown in that year, even more so than the regular rotation, not too surprising. So this strategy remains very interesting to me. However, I see that there are going to be times when it's not going to be returning 3x the regular strategy, and it may be significantly lagging the market. So something I'm still working on, and currently am kind of paper trading in that I list the results, but am not adding them to the model portfolio. Okay, so what could go wrong with this? If I haven't touched on this, pretty much everything. If the index loses 34%, the 3x ETF can go to 0. That would have to be kind of a one-day loss because they are able to rebalance, restart their leverage, You could also get into Zeno's paradox, if you remember from way back in math class, of this person who's running the race and goes half the distance, then half the distance, half the distance. He's always able to go half the distance, and how does he ever quite get across the finish line? Well, we know that he does. And then in the same way, if the index keeps losing 10%, adding up to 34%, pretty soon these leveraged ETFs will shut down. They'll drop really hard, and then they might have to shut down. So you've definitely got to get out of them before the crisis hits. And even without a crisis, you should be aware that the leveraged ETFs don't really do what their namesake leverage is, because there's a cost of leverage. And the drawdowns can be especially painful, not only because of that leverage, but because of the way it works. It can draw down even faster than its stated 3x goal. And of course, you know, the past performance is no guarantee of the future results. Something different will be coming out, and all we can do is use this as a guide to try and get our best strategy out there and do our best to protect and grow our nest eggs. Okay, so that kind of brings me to the conclusion and why ETF rotation is still my favorite strategy. And it's because it limits the damage of my faulty human biases. I've made many mistakes and been the wrong direction in the market, and tried to buy and hold and sold out too near the bottom, or have succeeded in holding on to some very small positions through thick and thin, and not been rewarded with that much of an annual gain, considering that they've gone through the tech wreck and the double dip recession and the credit crisis. And anyway, so having the rotation gives me an objective strategy to be able to decide when to be in the market and when to get defensive. And I really like having that built-in defense, because my entire investing career has been one crisis after another, and I am wary of putting everything in, having it go down, and having to wait for it to recover. Okay, so meanwhile, while I've had the money in the market using the ETF rotation strategy, it's been making money. So lately, we're just off of the new highs, haven't given back that much of the gains, and I'm happy to be in the market and to watch that objective indicator instead of being on the sidelines or getting in the wrong way for the current market environment. And finally, this strategy allows me the free time to spend on my hobbies, which I really enjoy. Okay, thanks a lot for listening. Please send me questions or comments if you have them. Email probably works the best, and I will look forward to recording another video and sending out more data as soon as I have it. Thank you very much.